Welcome back to the channel. My name is Leo, and in this video here we're going to be doing a stock analysis on Spotify. The company's been making headlines lately with this whole Joe Rogan, Neil Young fiasco, so I decided, you know what, let's dig deep into the fundamentals, look at the company metrics, the financials, and finally figure out a price to pay for Spotify and if it's worthy of being in your portfolio. Without further ado, let's roll the intro and let's get right to it. Alright, Spotify, one of my most used apps on my phone because I love blasting Barbie Girl from Aqua when I'm lifting weights. First things first, guys, let's make sure we smash the subscribe button, drop a like in the video, helps out the channel, makes me feel warm and fuzzy. Over the last year, we've seen a decrease on stock price from Spotify, hitting a high of 364, and now we're kind of in this 196 range. Okay. Alright, let's see what we're looking at. Okay, market cap of $37 billion. And it is not looking good, folks, right off the bat. PE, negative. Negative. This company does not make any money. On average, negative earnings per share. Average is negative. Return on equity, negative. 5-year return on equity, negative. I mean, I want to see a positive number. Return on equity, I want to see this at 15%, but I mean, it's a negative. It's, dear God. I don't know what to do with this company. Looking at these numbers here, profit margin slightly increasing from negative 12 to negative 1.3. So we're not losing as much money, I guess. Revenue, 9 billion, negative net income, but positive free cash flow? Question mark. Average free cash flow is 209 million. I do some more research on that. Kind of questionable, but this company makes no money. So how is their free cash flow? Return on invested capital is 0.82%. We want this number to be 10% on both sides, over 10. And we have negative 4, so that means they don't do a good job of investing their capital. Altman Z-score is at 5. And Piotrowski score is at 4. Our Altman Z-score is signifying that the next couple of years, the company will likely not go bankrupt. It's a software business, and they run off an app. So this is usually used for like businesses that have, let's say, like more of a tangible, I guess, items to it. So I'm not gonna even look at this number here. It's totally irrelevant. Piotrowski score 4. We want this to be between 7 and 9, ideally 8 or 9. It's at a 4, so incredibly low. So right off the bat, Spotify, not too happy with it. So let's move on to the financial evaluations checklist. But before we do that, if you're interested in obtaining the information that I have here on my screen, this is an app that I'm actually developing. Stay tuned, because this will become ideally, hopefully, either a web app or a mobile app, but it is in progression of heading that way to be more accessible to you, the viewer, and loyal subscriber. So keep an eye out for that. So, financial evaluations. We got a lovely score of 3 based off our checklist. Let's go through them right now. Of the 10 categories, PE ratio for the last average 5 years, negative 155.97. Current ratio, 1.31. For the just for the record, guys, we want this number to be under 20. I mean, technically it is, but we want it to be over 0. We want the company to be generating money. Current ratio, we want that number to be over 1.5. Having 1.5 and over means that they have enough assets to cover their liabilities. In this scenario, they technically have enough assets to cover their liabilities at a 1.31 ratio, but we want a 1.5. We want that extra cushion. ROE average, negative 11.19. Terrible. We want this over 15. EPS growth, it has just been decreasing. Love that. Debt to equity, it's 20%. So they are using financial leverage within the company like the building equity through there to fund a lot of their activities. Moving on to share dilution, we have an increase. Not too great. This is a silent killer of a company because issuing more shares just is gonna dilute you, the investor, in this company. We don't want that. We want to see companies just ideally decreasing the amount of shares outstanding or just keeping them the same. So that's not healthy. 5-year net income growth, we're in the negatives. 5-year free cash flow growth, we're in the positive. So we've grown it a lot. I want to say they had a negative, negative free cash flow. I'm gonna say that they had negative free cash flow before, and then they just broke into the positive because you don't just bring in $9 billion worth of revenue and have 245 million free cash flow. But what doesn't make sense is that they're also not making money. So that's confusing to me. 5-year return on invested capital, as we know, it's negative 4%. That's absolutely horrendous. And 5-year revenue growth, 32.88%. So the revenue is growing. Okay, that's a positive. But we got 3 out of 10. Right off the bat, to be honest, I wouldn't even take a look at this. I would just, okay, that's done. I'm not going to even bother owning Spotify. I love the app. I think the app is phenomenal. But what I'm seeing here is an absolute disaster. So, anyways, in that regard, let's go into a price analysis and see what should we pay for Spotify. My God, what numbers are we going to use? Okay. So 10-year analysis, revenue growth. We got 44%, 32, and 16. So obviously the company's been, there's massive growth because it's a fairly young company. But I am going to just assume the absolute conservative, like honestly, here. 16, 17, 18% revenue growth over the next 10 years. Profit margin. I don't even, this company doesn't even make money. So, like, I don't know, 0, 1, 2. Free cash flow. 2 and 4. I don't even have a 10-year number for either of these categories. So I got 2 and 4%. Okay, I'm gonna just go with. I'll just go 2, 3, 4. Price to free cash flow. My God, this number is 130. I'm gonna go with the 14, 16, 18. That's my conservative, aggressive numbers. PE ratio. Dude, 12, 14, 16. These numbers are going to be absolutely ridiculous because like, so we got a 0 here, guys. So as it stands today, at the price of $196 on average, you should be paying $56 for this company, assuming the revenue is going to grow these amounts, 16%. Right? Okay. Well, let's say it's more so in the middle. Okay, so let's say in the moderate category, let's go to just the one down the middle. 70% revenue growth over the next 10 years. Somewhat feasible, I guess. We just hit 16. Looks like it's slowing down. I mean, sure. Profit margin. We have to make a profit of 1%. We're at negative 12 and negative 7. So that's today. That's starting from today, folks. After this year, we're making 1% profit, and for the next 10 years, free cash flow margin 3. and then a price to free cash flow of 16 will be hit in the next 10 years. PE ratio will go from negative 266 to 14. This is a 13% desired return. That would take us to this 53 mark, 56. My God. For our aggressive category, we would pay $100 or $90 on average for this company to hit all these marks. So here's my thing with Spotify. Because it makes no money, like these are all things that would have to happen. We have to like not win the lottery per se, but the company has to start making money for it to even be thought of as an investment. There's all these negative numbers. I wouldn't touch this with a 10-foot pole, but that's just my opinion. This price has to fall a considerable amount for me to just even put it on a watch list. But yeah, this software is coming soon. So if this is something that interests you, yeah, send me a message. I'll put you on a list. But yeah, that is my thoughts on Spotify. Thank you so much for tuning in, guys. I'll see you in the next video. Drop a comment down below on companies that you want to see analyzed. And I'll see you in the next one. Thanks.